In this video, I'm going to show you everything you need to know about capitalization rates in commercial real estate. Hey everybody, welcome to my channel. I am your host, Leo Landaverde, outsourced CFO and commercial lender, helping you scale your business. If you're ready to grow your business to 7 figures and beyond while creating the financial freedom and the lifestyle you want, don't forget to hit the bell and subscribe to my channel, and you'll be notified every time new fresh content comes out. A couple of weeks ago, I did a video called Underwriting Commercial Loans, in which I talked about the 4 main criteria for underwriting loans. If you haven't watched that video, I encourage you to do so. I'm not gonna go over everything, but we did talk about 4 things, which were the debt service coverage ratio, which has its own video, the LTV, which was another video, the cash on cash return, and capitalization rate. Today, we dive deeper into capitalization rate, also known as cap rate. So with that, let's go in. The short in the industry is cap rate. So when we talk about cap rates, we're talking about capitalization rate. And what is that? It's a metric. It's an underwriting metric. It's a metric that you should be using as an investor, as a commercial investor. If you're thinking about buying a commercial property, you need to be very familiar with cap rates. And cap rates, it's basically, the formula is net operating income of the subject property divided into the purchase price. And that's a number. Now, the net operating income, you need to understand that does not include debt service. So it's truly the operating expense or the OPEX of that subject property, whether it is 1 to 4 units or 5+ units. If it is 1 to 4 will be residential, 5+ will be commercial, real estate, it doesn't matter. The net operating income is the cost of servicing, basically the expenses related to servicing the property. And it gives you net operating income. The net operating income divided into the purchase price is going to give you the cap rates. Now, so here's just the kind of like the basic thing about the higher the cap rate, the higher the risk. The lower the cap rate, the lower the risk. Now, it may sound a little counterintuitive, but let me illustrate. So, with some examples. Now, keep in mind that the cap rate is one of the many things that you're going to be evaluating when purchasing a property. You're going to also be looking at other things, so we're going to use this and expand. So in example number 1, you have a purchase price of $1 million property and a net operating income of $75,000. So if you take the $75,000 and you divide it into the $1 million, it's going to give you a 7.5% cap rate. Okay, that's pretty good. Okay. We're gonna go to the next one. And the next example, you have a purchase price of $500,000. It could be a triplex somewhere in the United States. If it is in California, it may just buy you the dirt. But so you have a purchase price of $500,000 and net operating income of $50,000. You take the $50,000 into the $500,000 and you get a 10% cap rate. Hey, it sounds good on paper, right? There's more than meets the eye. In this last example, say you have a purchase price of $5 million. It may be a 10-unit building, maybe $50,000 a door, and you have net operating income of $250,000. Now, if you take the $250 divided into the $5 million, it's going to give you a 5% cap rate. Now, what you have to understand is this: there's things like location. You heard it say, what are the 3 most important rules in real estate? Location, location, location. Well, it's not necessarily just location, but it plays a very big role. So say, for instance, this 7.5% cap rate, and but then you realize that this is in Idaho. Okay? And then you have this 10% cap rate in SBB in Central California. And the 5% cap rate, it could be Miami or it could be LA. Okay, so when an investor is looking at this, remember what I said? When you have a lower cap rate, it assumes several things. It assumes a stable market. So if in bigger cities, you have more population, which means you have lesser vacancy. Vacancy is a very big factor and it's going to lower your net operating income. In bigger cities and bigger markets like Miami and LA, investors particularly the institutional investors, don't mind paying for, I've seen a cap rates of 3%, because what they want is a stable property that has almost no vacancy. Now, you do factor a 5% vacancy in your calculations, but if you're running if you're running the business and the property, you're running it well, and it's well maintained, and it's in a city where there's very little vacancy, there are a lot of people that are gonna wanna rent your property, it's worth a premium, right? So investors are gonna be willing to pay a premium for lower net operating income that is not gonna fluctuate very much. So conversely, the opposite is true. If you have a 10% cap rate and say this is in Central California and it's a depressed market and people are living in droves and they're moving out of the state or they're moving to other cities because there's no employment, this may be a fourplex and maybe 125,000 a unit, and it appears that the 50,000 at 10% cap rate is pretty good until half your tenants are gone. Now you have 50% vacancy. Now all of a sudden that 10% cap rate doesn't sound so good. So you got to think through this. So you start with location. So you take the cap rate and it's basically a deal point. Now you want to look at the location where this is located. You need to know what you want. Right? Again, the debt service plays no role in this because you may be a buyer with cash on cash. You be willing to pay cash for the whole thing, so you won't have a mortgage. So it's really understanding what you want. So you got to factor interest. So location is first, and then you got to look at interest rates. Now, when interests are rising, that means that the cost of debt also increases, which decreases your net cash flow. So the higher the interest rates, it's gonna mean you're gonna have to basically pay more for the cash that you borrow. Also, what plays another role is the asset class. Now, if you're, there are many different types of asset class when it comes to commercial real estate. You got office, and if you're an investor and if you realize, well, we are in the middle of a pandemic and most people are working from home, and if you're looking at a B or C, office building, you may be in trouble, right? Depending on whatever market you're in. Just because people don't want to rent your space, you may be having problems with, leasing the space, and you may have a high vacancy rate. So industrial, there's retail, there's hotel, but the one asset class that has historically done well, it's multifamily. So if you're a commercial real estate investor, you can't go wrong with a 1 to 4 units or 5+, because people will always need a place to live. So that's never gonna go away. So I think if you have several apartment buildings and you want to venture into, I'll say, storage, mini storage is also a good way to go. But again, back to is cap rate essentially is the net operating income divided into the purchase price. Now, if you combine that with the debt service coverage ratio and the cash on cash return and the LTV, now you're starting to really evaluate and going deeper and thinking more of if this would be a good deal for you. Hopefully that video helps you out. Hey, please comment below and let me know if this video was useful and if I can help you in any way with any commercial real estate projects. Also, if you want to join a community of like-minded, successful entrepreneurs just like you, then join our Facebook group at the link below, where I share tips, tactics, and strategies on how my clients are growing their businesses to 7 figures and beyond.